Okay. Banks are evil. I hate banks. I cannot stand banks. The account maintenance fees, ATM withdrawal fees, overage fees, insufficient fund fees. People write you a bad check, you get charged. Banks are evil. I do not like banks. Okay. Now I know that they're necessary for some things, and banks have completely shifted their profit model to fees. They just want to charge you to make fees. And banks, 75% of all their fees are paid by the lowest 25% of people with balances and income. So they take money from people that they can't even afford that money to lose. Nobody can, but that's how they make money. Just so you understand how they operate.
Well, they charge you fees for putting your money into their account.
Yeah, I mean, it's terrible. And they give you a little sucker, right? A lollipop, because you're a sucker, right? That's what they do.
Right.
But you're right. The second way that banks make money is they leverage. Okay. So Jean deposits her money with me. I'm a bank. I don't put that money in the vault. I reinvest it. I put it out in the global economy. That's where you get this concept of what we call investment banking. So I could invest it in companies. I could purchase other banks. I could lend it to other customers of the bank. So Jean deposits your money with me. Do I give you high or low interest?
You give me low interest.
Right, very low interest. If you ever see 0.0 and then a lot of numbers, it's still a small number, even though there's a lot of numbers behind the zero. Betty comes and borrows your money to buy a car or a home or a personal loan, and I'm going to charge her a lot more than I charge you. And you can see the signs. They're up in the bank. Deposit your money and it'll be 1%. Borrow money as low as 3%, right? That's how banks make money. They make money by charging fees and leveraging your money by giving interest. So what we do is we teach people to bypass the bank.
I like that.
We teach people to invest in the global economy yourself. Everything a bank can do, you can do. Mm-hmm. Everything that they can do, you can do. Okay. Now, this isn't hedge funds. We're not investing in anything. No one's giving you any cash. I want everybody to understand that. Okay. We're talking about stuff that your 401k or your IRA is invested in. Fortune 500 companies, Standard & Poor 500 companies, Dow 30 companies, big companies that you've heard of, okay? Now, so what we do, okay, and, Betty, I see you, so I'll use you, okay, because you got your video on. I appreciate that. And you're new, Jean, I know you're new too, but so do we pick the stocks for people?
No.
How does it work? Do you know?
No.
Okay. So we do help with portfolios, okay? But we don't pick the stocks, okay? So a mutual fund, okay, is a fund, right, where investors pool their assets together. And they give it to what they call a mutual fund manager or a management team, okay? And that's where you see investing with professional management. We use companies like you've heard of, like Fidelity or American Funds or Van Kampen or Smith Barney. We use the biggest mutual fund companies. These companies are ran by mutual fund managers that pick the company. So we manage the relationship with the client. We don't have to be Googling company. Now you can do that for your own research and you'll learn how to analyze companies a little bit better by working here and getting your licenses. But that responsibility does not fall on us. Okay. We put the money in the global economy and we use concepts like dollar cost averaging, which means systematic or monthly investing. I actually invest every week, multiple times a month, even more than every week, because I don't want to write a check, right, for $10,000 or $15,000 a month to invest. I'd rather invest $3,000 to $5,000 every single week. It's easier for me to stomach. We also use discipline and then diversification. So we're not investing in one or two companies. We are protected through diversification. several different companies over several different industries. Okay. See, investing in stocks requires skills. You got to pick one company, two companies, three companies, four companies, five companies. You got to know a lot of research on these companies, which we don't have access to that. We don't know anything. Our means of research is Google. That's not enough. When these mutual fund companies, right, like the company I like to use, and we can use, I have no attachment to any of them, but I like American funds because that's where my money is. Now it's called Capital Group because it's not just an American company, it's an international company. They're the #1 money managed mutual fund company. All of my money is there. All of my in-laws' money, my parents' money are with American funds. They're the #1 company. They spend $140 million a year researching companies. They interview the employees, the buyers, the suppliers. They audit every financial record, they look at all the taxes before they invest in a company. I'll give you an example. American Funds is the #1 money managed mutual fund company. Okay. They have over $1.5 trillion in assets. Okay. Now, Betty.
Yes.
In 2001, do you know what the most, and this is a very obscure question, okay? Do you know what the most widely held stock and best performing stock was in early 2001?
No.
In the early 2000s, it was Enron. Enron was the #1. Do you remember Enron?
No, not really.
Okay, so Enron was the energy company that that contributed to one of the biggest accounting scandals in American history. Okay, it was an energy company. And Enron was the most widely held stock, and it was the best performing stock of its era. And American funds didn't have of $1.5 trillion, they didn't have $1 invested in Enron. Think about that. Why? Because when they researched the company, they couldn't figure out how the company made money. Something about it didn't add up. See, we trust the professionals in their research and their research team and the money that they invest in researching these companies. So you can feel very confident in investing your client's money into, and like, for example, American Funds in particular has been around for over 100 years. So they've seen ups, downs, administration changes, recessions, bull markets, everything. World War I, World War II, Kennedy assassination, .com crash, financial tsunami in 2007 and 8. So it pays to start investing early. We believe also you need to invest early. A one-time investment of $1,000 at 12%. If you invested right at age 40, that would be $21,000. If you invested at age 16, that'd be $323,000. If you do a $1,000 investment when someone's born and by the time they turn 67, just $1,000, they have $1.98 million, basically $2 million. Think about that. But if you wait till 16, that $2 million will only be $323,000. And if you wait till 40, that $1,000 would only become $21,000. See, we teach people the power of compound interest. Right? It says that your money will double at a certain point determined by dividing 72 by the percent that you obtain, right? So 72 divided by 3 is 24. Every 24 years, your money will double. So 10 goes to 20, 24, and in another 24 years, 20 goes to 40. 72 divided by 6 is 12. 10, 20, 40, 80, 160. But 72 divided by 12 is every 6 years your money doubles. 10, 20, 40, 80, 60, 320, 640, 1.2, 2. See, that's the power of compound interest. Albert Einstein said compound interest is the most powerful force in the universe. See, most people think if you wait, see, if I'm getting 12% and I wait 6 years, well, I have 10,000 and Betty has 20,000. I think, oh, it only cost me 10,000. No, it actually cost me 1.2 million if you extrapolate that over time. That's called the high cost of waiting. Look at the time value of money. This is one of my favorite things that I show my clients. Say I have two brothers, okay, ages 22 to 29. Brother A decides to contribute to his IRA. And the max you can do is $5,500 a year. Okay, this is when this was done. Now it's 6,000. They just changed it. Okay, so say Chelsea is my twin sibling. Chelsea decides to save from 22 to 29 for 7 years, $5,500. They've put in $44,000. You can see that, Chelsea? Okay. You know what? I'm irresponsible financially. I don't want to save. I'll save when I get older. I don't need to be thinking about retirement right now. I'm way too young. So from 22 to 29, I don't want to save. Now, 29 at 30, Chelsea, you decide, you know what? I'm going to stop saving. In your account, which you put in $44,000 is $67,000. You think this money hasn't grown that much. I've been doing this for 7 years. I put in 44, it's only 67. I'm done. I'm going to leave it, but I'm not going to put in anymore. Now I have an epiphany at age 30 and I just start saving religiously, consistently. I'm very diligent with it. And I invest $5,500 a month from 30 to 67. So for 37 years, I contribute $209,000. And guess what, Chelsea? You still have more money than I do at 67. Why? You started early. I know it's hard to save now, but if you are frugal, it's going to be less money than later. Why? Because time is the most important thing when investing. And so you got to get started young. Pay off debt. Okay. So we teach people the difference between revolving and fixed interest. Okay. So a variable debt or revolving debt means that you pay a percentage of a balance, like a credit card. So you have a minimum payment. Okay. So say, for example, you owe $5,000 and you on a credit card and you're going to pay, 3%, which is $150. Well, as your balance goes down, your payment goes down. Why? Because you're paying a percentage of the balance. A fixed payment means your payment stays the same and your balance is here. And when the balance goes down, the payment stays the same. Now, this may look minor, but I always say things like this. Small things make a big difference. And if you look at this, look at how crazy this is. Do you know if you made a one-time $3,000 credit card purchase with an 18% interest rate with no new purchases and made only the minimum payments, it would take 10 years to pay off. And you would end up paying more than $2,000 in interest charges. See, we never look at total cost of things. We always look at monthly payment and what's the interest rate. Well, there's different factors that these companies can do to make you in debt longer and trick you with the interest rate, because the rate actually might look low, but you're actually paying more interest because of time and the way the interest is calculated. Look at how revolving debt can erode your financial security. I think debt is one of the biggest killers of dreams, especially when it comes to financially. That is my mission at the very least for all of you. If you have any debt, I want you to write a goal to pay off all your debt. I want you to get on a debt elimination plan to pay off all of your debt. That's one of the most important things I think that you could ever do. Okay. Look at how revolving debt can erode your financial security. Revolving debt, $17,000 balance at 18%, paying $595 a month. It would take you 17 years and 2 months to pay that off. And of that 17,000, you're going to pay 12,500 in interest. Fixed debt, 17,000 at 18%, paying $595. You'll pay that off in 3 years and 2 months, and you pay $5,000 in interest. Same debt, same interest rate, but the way the interest is calculated is different. And one takes you 3 years to pay off, and one takes you 17 years to pay off. Crazy. So one thing that we use is we use something called a debt stacker. This is completely free for the client. This does not cost any money. Most of our debt programs do not cost the client any money. It's just, we have with our money GPS, a systematic way to see when most people pay off their debt, they have no idea how they're paying off their debt. They kind of do it aimlessly. They're well-intentioned in wanting to pay off their debt. They may even pay a little bit more than the minimums, but they have no rhyme or reason on how they're applying the overage to their debt. So this client is paying retail card 1, credit card, 2 credit cards, a car loan, and a mortgage. Okay, and they're mainly making the minimum payments. So what we do is we teach them, well, you know what, Mary, when you pay off this credit card, don't go get another one. Don't go spend the money. You apply that to the next debt. So right now your current debt outlay is $2,720. We're going to keep that. Even when you start paying off some of your debts, we're going to keep you paying $2,720 to your debt. You'll just accelerate some of your other debt. And you'll do that till all of your debt is paid off. Now let's look at the significant impact that has on your financial situation. Okay. Without the debt stacking, this client would have been out of debt in 23 years. And they would have paid $214,000 in interest, and their monthly payments are $2,720. With the debt stacking program that I just showed you, which is also called the debt snowball, where we attack each debt. When we pay it off, we apply it to the other debt. We will save this client $130,000 of interest. They'll be out of debt in 9 years, 14 years earlier, and we're not using any extra money. Is that a big deal or a small deal? I mean, imagine getting out of debt 14 years earlier and saving. Why? These little things by applying more debt. Because, what do people do when they pay off a debt? They go get another one. They get a bigger one because they're overconfident. They have an extra $300 a month. They go finance a car. They go buy a boat. They do things that do not help them financially, and they usually finance it. And remember, when you're borrowing money, you're spending future money. So you're losing today. I mean, you're utilizing today, but you're losing your future financially. Here are the most common credit mistakes. People don't value their credit. And then when you do not become credit worthy, what happens is you get charged a lot more money. You have to jump through a lot of high hoops. Like I said, a lot of my bills were in collections. I had to fix my credit. I'm not proud about that. I'm embarrassed, but I want you to understand, if that's you, you can fix it. Raising credit card limits. I don't know how you guys are. I'm just not great with temptation. Okay, so I'm just not great with it. I don't like to go near the edge of the pool because I know I'm going to jump in, right? So I don't try to tempt myself. Credit card, these companies are very smart. They know how to get people. They know how to get younger and younger people in debt for longer periods of time, so they never pay off their debt. Not monitoring your credit history, right? Because there is fraudulent credit activity that can cost you, and you do want to monitor that. Not monitoring your credit score and not knowing your interest rates and fees. And most people ask the wrong questions. Write this down. What's it going to cost me monthly? And what's the interest rate? Those are the wrong questions. It should be, how long am I going to be in debt? And what is the total cost? Oh, this car is only $23,000, but the way you finance it's going to cost you $40,000. Would you still buy it? That's the way you got to ask. Buying the right kind of life insurance. Huge mistake that people make. Number one, they don't have enough life insurance, or they don't own any life insurance. You have to have insurance. If you want to protect your kids, your family, your wife, your husband, your dependents, you protect your standard of living. How much is your car worth? Do you insure it? And if something happened to that, would you want half of your car replaced or all of it? How much is your house worth? Do you insure it? Why do you have to insure it? Would you ever not insure your house? What if you got a fire or damage, right? You understand, because to you, it's an asset. Your life, it's not that life insurance does not protect you from dying. It does not bring you back from the dead. It's not a seatbelt. What it does is it protects your family, because you are an ATM machine to your family. You are a breadwinner. If I had a job and I'm making $150,000 a year, I make $12,000 a month. That money would go right when I go, but my bills wouldn't stop. And what will my wife do? Well, she'd get a job. Okay, so she wants to deal with getting a job, 3 young kids while I just died. I just died at the same time. You know, and read GoFundMe's once in a while. It's the most heartbreaking things in the world, but that all of them could be avoided with life insurance. All of them. So we believe in something called the theory of decreasing responsibility. We believe in the early years, you need a lot of coverage. Why? Why do people need coverage? Because they don't have money saved. If you have money saved, if you have $1 million, you don't need, now you can still have life insurance. Does Bill Gates need life insurance? No, if he dies, his family's fine. So you don't need life insurance forever. Life insurance is not a permanent need. It's a temporary need. Now, when do you need it? You need it when you need it. And when do you need it? Is when you have young children. Why? Because children cannot, they're dependents financially. You need it when you have high debt, student loans, a mortgage, credit card payments. And you need it when you have not accumulated money. You're in what we call the accumulation phase. But guess what? Your needs change over time. You pay off your debt. You have a retirement account. Your kids are grown up where, yes, you could still help them financially, but they don't need you financially. You have a retirement or an emergency fund. And your family is not as dependent on your income because you've done the right things financially. So in the early years, you may need coverage. Why? You don't have money. But later years, you may not need coverage. Why? You have to have money, grown children, lower debt, mortgage paid. This is called the theory of decreasing responsibility. This is the basis of financial planning. Right here, this slide right here is the most important thing that I've shown you today. This is how a financial plan works. Eliminate debt, save for retirement, save for college, save for the future. And in the meantime, protect yourself with life insurance, with a will, because if something happens to you during that accumulation phase, your family is permanently devastated. See, this is common sense. Eliminate debt, save for the future, protect yourself. You do those 33 things, you're going to be fine financially. Never buy any kind of cash value or whole life insurance, including universal life. Never buy life insurance as an investment. Never buy a life insurance policy that pays dividends, ever. If you know anybody, we need to get those. If you have that policy, if you know anybody that has a policy like that, we need to get them out of that policy immediately. These are the worst types of policies that you can own. They're the biggest ripoff. They're good for the agent. They're good for the company. They're terrible for the agent. You should never be owning things for your entire life, like life insurance, right? I mean, if you wouldn't have car insurance your whole life, if you don't have a car, you don't need car insurance. Once you have money saved up, you do not need life insurance. Life insurance is only good upon death. But if you have $500,000 saved up, you're what we call self-insured. You do not need insurance anymore. And I got to fly through some of this because I ran out of time. So,